Hi friends, this may be my last video on insurance topic because after watching this video, it is likely that I may get legal notices from many insurance companies, but I'm not scared at all from speaking the truth about the insurance plans in India and how insurance companies and insurance agents are literally looting the money from people. The new buzzwords that they are creating, such as return of premium, zero cost term plan, all of these are traps. If you do not understand them, please understand the nuances of these variants before even you sign up for these. And in this video, I will talk about two of such variants that lately insurance companies and insurance agents have been selling like anything. The first trap of life insurance policies nowadays is called return of premium. For this, your insurance agent, Mr. Chaman Lal, will give you a call and the conversation will go something like this. Hello sir, this is Chaman Lal here. Remember me sir? I got you your last life insurance policy? Yes sir. Sir, I know you are paying 3,400 rupees per month and I know your life insurance policy is for 40 years. And this policy, no doubt, is a great policy. I only sold it to you sir. But sir, there is only a small problem with this policy that after 40 years, if you are alive, which I know sir, you will be alive. After 40 years, if you are alive, then you are not going to get any premium back. All this premium is going to go into dustbin sir. That is why I am calling you sir, because in the market, there is a new insurance company called IWillLootYou.com. And sir, this new company, IWillLootYou.com, what they have come up with is a new scheme sir. As part of this scheme, you need to pay 6,200 rupees per month. So rather than 3,400 rupees per month, you will need to pay 6,200 rupees per month. And this policy will also be for 40 years. But sir, after 40 years, this policy will give you all your premium back to you, sir. So in 40 years, you would have paid 30 lakh rupees, sir. This company will give you 30 lakh rupees back after 40 years, sir. And also, sir, all the terms and conditions of this new policy is exactly same as your policy. Shall I go ahead and book this policy for you, sir? Now tell me if this Chaman Lal had called you and had given you this option that, hey Rahul, you take this 6,200 rupees per month of policy for 40 years and you get all your 30 lakh rupees back, versus you carry on with your existing policy of paying 3,400 rupees per month and you get nothing back. Which one are you going to take? And if you are going for 6,200 rupees per month and take all your 30 lakhs back, my dear friend, please understand this calculation before making that decision. What you see on my screen is option 1, where you're paying 3,400 rupees per month and after 40 years you get nothing back. But in option 2, you are paying close to 6,200 rupees per month. You're paying 2,800 rupees per month more. But in this option, you are going to get this 30 lakh rupees back after 40 years, right? Now, let me show you, if you do not take option 2, which is get all your premium back, and you stick to your option 1, which is 3,400 rupees per month, then this 2,800 rupees per month that you have in your pocket, what you can do is you can invest this money. Even if you do a fixed deposit, and if I consider 8% rate of return, then this amount in 40 years is going to become 1,75,000 rupees. You can see the calculation, simple calculation I have done here. And that means 70 lakh rupees you will be able to save, because here you will only get 30 lakh rupees, but in option 1 you are going to get 1,75 lakh rupees. So by giving this 2,800 rupees extra to your insurance company or Mr. Chaman Lal, what they have done is, even if they go and do a simple FD, they are going to earn 70 lakh rupees on your money, right? And if you can think beyond fixed deposits, even if you go for index fund, simple index mutual fund, at 10% rate of return, this amount will become 1,82 lakh rupees. At 12%, which is what Nifty 50 has given in the last 10 to 15 years. Please watch my videos on index mutual fund on my channel. You will easily understand it. Then in that case, you are going to save 3,40 lakh rupees. Again, at 15%, people who can invest in active mutual funds like small cap mutual funds or even stocks, then in that case, you are going to have 9 crore rupees with you. At 20% for advanced investors, the amount can go up to 48 crore 78 lakhs. Now, why this amount is multiplying? Simply because you have not understood the time value of money, but your insurance company and your Mr. Chaman Lal, who is not so Chaman Lal, has understood this, that if you invest the money for 40 years of period, that is going to give you massive returns. Even if your rate of return is like 8%, 10%, 9%, you're still going to make a lot of money with that incremental premium. And that is why the insurance companies are giving you all of your premium back. Otherwise, they have to make money. They have to pay the salaries of the insurance agents. There are no free lunches in this world. And this is why we need honest insurance platforms. And I have no hesitation to recommend Ditto Insurance Platform because they are 100% honest and totally spam free. Ditto have a rating of 4.9 on Google and have advised more than 200,000 customers. And the reason I trust them, because they are backed by Zerodha. You can call Ditto's expert advisors at zero cost. And when you call them, ask them the difference of the premium between return of premium versus a regular option and do the calculations for yourself. And let me know in the comments if you would like the simple calculator. I will upload it in a Google Drive and share the link with you so that you can do the calculation and you can make informed decisions. And also, if you are liking this video, simply don't be lazy and just hit the like button, share it with your friends so that everybody can be educated. The second trap of life insurance policies nowadays that people are selling is zero cost term plan. And as we say that there are good cops and bad cops, zero cost term plan also has exactly the same thing. Good zero cost term plans and bad zero cost term plans. Let me first explain to you the bad cost term plans so that you can totally avoid it, because just by not opting for bad zero cost term plans, you can save lakhs of rupees. And for this, you need to understand one basic concept of life insurance policies, for which let me take an example. So let us say you have two insurance policies. Insurance policy number one is it will cover you up to your age of 55 years. And the second policy will cover you up to the age of 70 years. Now, all things being equal, tell me which policy is going to cost you more premium per month. It will be 70 years policy, because as human beings, our chances of dying increases after the age of 65. More chances is that your nominees are going to claim this money from policy number 2, which is covering you up to 70 years. Therefore, when you start paying premium from day 1, your insurance amount, your premium amount is going to be higher in cases of 70 years. And for this, I also looked at the internet and I found these two versions. So let us say that you are taking insurance policy that is covering you up to 55 years of age. All things being equal, for example, your insurance cover is 3 crores. You are going to pay 2,339 rupees per month. But if you take a policy of 70 years, then you're going to pay 3,398 rupees per month. Now, with this background, let me explain to you the bad zero cost term insurance plan. For this, what I'm doing is I'm going to Ditto's website, a very, very beautifully written article by Ditto's team here. And if you come down here, they have got a case study here. Assuming that you're a 30-year-old and you take a term insurance plan, a bad zero cost term plan will come with certain ifs and buts. And what are those two ifs and buts? Number one is that your insurance agent will tell you that the zero cost variant is only available for policies that is spanning for 40 years or more. Meaning they are trying to take more premium from you, as we just saw in the example that if you take a policy for more than 40 years, then you are going to pay more premium. So number one condition that they will put is that your zero cost variant is only available for policies which are longer duration. And the second caveat they will say is that you will have to surrender this policy before the 25th policy year. Meaning if you are 30 years of age right now, they will sell you policy of zero cost term plan that will take you to up to the 70 years of age. But what they're also putting a condition is that by the age of 55, you will have to surrender this policy to get your premium back. Meaning that they have sold you a term insurance policy with a higher premium, which is the premium of 40 years policy, but they are then asking you to surrender it by the age of 55, meaning they are essentially selling you a 25 years of policy with 40 years of premium. Let me now show you how much of money you are going to lose just because of this. So what you see on my screen is simple calculations. Let us say you go for option 1, which is that you are not taking the zero cost term plan. You're simply buying an insurance policy for covering up to age of 55 years. You're going to pay 2,339 rupees every month. In option 2, you are taking the zero cost term plan, which covers you up to 70 years, but then you have to surrender the policy by 55. So it is one and the same thing. But in this example, if the company is asking you to pay 3,398 rupees, you will end up paying 1,059 rupees every month in addition to 2,300 rupees. Now, after 55 years, in option 2, you are going to get 10 lakh rupees back. All your insurance given back to you. But in option 1, you are not going to get anything back. So if we do the calculations of this 1,059 rupees, if you invest now at 8% rate, it almost balances out, means the zero cost term plan is not a bad option if you are able to do 8% returns, which is typically a FD return. But if you go for 10% returns, again, you are going to have 14 lakh rupees instead of 10 lakh rupees at 12% rate, which is very, very much doable on a 40 years of time horizon, even if you put this money in Nifty 50. Past history tells us that, of course, there is no guarantee if you put it into mutual funds, but at 12%, you are going to get 20 lakh rupees. At 15%, you are going to get 34 lakh rupees. And at 20%, you are going to get 91 lakh rupees. That is almost 9 times more. It really depends on, can you really invest this money safely or not? In my view, generating 10 to 20% every year is not a rocket science anymore for people like you and me, because nowadays we are all understanding mutual funds and stocks. But if you also want to understand how stocks works, how mutual funds work in greater details, then you can consider subscribing to my YouTube member community, because I share exclusive in-depth analysis on various assets and you will get benefited. But coming back to this calculation here, what you really need to do is, when you're calling your insurance agent, or if an insurance agent is calling to you, ask them the difference between the premium between zero cost term and the regular one. Do the calculation. So for example, rather than 3,300 rupees, if it was 3,000 only, then in that case, 10% interest is also neck to neck. Then you can think about going to the zero cost term plan. And if I bring it to 2,339, in that case, you can see you are better off with the zero cost term plan. This is what I mean by a good zero cost term plan. A zero cost term plan will come with no additional premium. So if they are giving you that flexibility that at the age of 55 you can surrender this policy, but right now you don't need to pay any additional premium, because you will have 7 lakh rupees given back to you at the age of 55. And more importantly, you need to decide that at the age of 55 whether you are ready to surrender this policy or not. And only if you feel that you are financially independent, then maybe you can take that chance. But if you're not financially independent, you carry on with your policy for 70 years. So before you take zero cost term insurance plan, please check 2 things. First, your insurer would ask you to take this policy up to a specific age, let us say 70 years. Now, just because you want to have zero cost term plan, please do not take this policy and pay unnecessarily high premium. Only stick by what your requirement is really. Second point, let us assume that ideal tenure that you want the policy for is matching with the zero cost term plan. The insurer would only give you this premium back if you surrender this policy at a specific age. But in future, you must only surrender this policy if you are financially independent, rather than just blindly taking the money back. Selecting the right term insurance policy might be confusing because of a lot of jargons, lot of T's and C's. And this is why I say you can call Ditto's expert insurance advisors at a zero cost, because they will give you 100% honest and spam free advice. You can right away call Ditto Insurance. You will find the link in the description. Last point, what is the difference between return of premium and zero cost plan? Because both these variants give you your premium back. The difference is very clear. If you go to Ditto's website, a beautifully written article again by Ditto's team. And what this article says is that in the return of premium, you will only get the premium back after the policy is finished. But in the zero cost term plan, you will get your premium back before the policy matures at a specific age, which is what the insurer will tell you upfront. I hope you enjoyed this video and learned something new. If you did, let me know in the comments a simple thank you. It will motivate me to bring such topics onto my channel. Also, a big announcement, I have also started a new Hindi channel. You will find the link in the comments. Please do check it out. And if you like the videos, support me there as well. With that, I will see you in my next video. Until then, keep rocking.